Welcome participants of the 2024 Traders Playbook. The conference is now officially open. To kick off the special event, let us welcome our distinguished host. She is a multi-awarded TV news anchor and presenter, an accomplished academic with a PhD in finance, a model, and professional host who specializes in business and economic events. Our host for today, Dr. Danny Laurel.
Esteemed speakers and guests of the Traders Playbook 2024, a warm welcome to each of you as we embark on an exciting afternoon together. This year's theme, Rising Through Risks, a journey down the rabbit hole into resilience and strength, sets the stage as we explore the outlook on the Philippine economy and the Philippine Equities Market in 2024. Drawing inspiration from Alice's journey down the rabbit hole, we acknowledge the challenges and uncertainties that lie ahead. But just as Alice embraced adventure with courage and curiosity, this virtual conference aims to equip all of us with valuable insights and strategies to navigate the twists and turns of the market. Before we kick off our discussion, let us take a moment for the opening prayer followed by the national anthem. To lead us in the opening prayer, let us welcome Mr. Andoy Beltran, Vice President and Head of Business Development and Market Education at First Metro Securities.
Let us put ourselves in the presence of the Lord in the name of the Father, Son, Holy Spirit. Heavenly Father, we humbly come before you today, grateful for all the blessings you have bestowed upon our nation, our government officials, the leaders of the First Metro Group, and all of its employees. We would like to lift up in prayer this Traders Playbook 2024 event, that as we go along, may your divine guidance be with us. Bless all the speakers and attendees with wisdom, that all the discussion happening today will be impactful and enlightening at the same time. May this event be a resounding success, fostering knowledge, collaboration, and prosperity within our community and nation as a whole. Heavenly Father, we entrust these prayers to your divine care, believing in your unwavering love and guidance. May our leaders, our company, and our colleagues find favor in your sight as we strive for a better and brighter future. We express our gratitude for your continuous blessings in the name of the Father, and of the Son, and of the Holy Spirit.
Ladies and gentlemen, to deliver the opening remarks, it is my honor to introduce Mr. Jose Patricio Dumlao, the President of First Metro Investment Corporation and the Chairman of First Metro Securities.
Good afternoon. Welcome, ladies and gentlemen, and our very esteemed guests to First Metro Securities Traders Playbook 2024. I'm really happy to be with you, kicking off this event and sharing some opening thoughts on behalf of First Metro Securities. We gather today to explore what lies ahead in the economic landscape. Reflecting on the past year, it's undeniable our local market has been through quite a rough and difficult journey. We've faced our fair share of challenges, from the persistent elevated inflation and interest rates to the continued exodus of foreign investors and the worrisome depressed volume of our local stock market to its roller coaster ride of the market's performance, which ended flat to the start of the year. What's more, with ongoing conflicts and geopolitical tensions brewing, no wonder things feel frustrating and worrisome at times. But amidst all these, there's something special about being here today. The Traders Playbook isn't just another event. It's a unique opportunity for us to come together and share ideas and figure things out. So as we dive into the discussions and analysis ahead, let's do it with a sense of camaraderie and collaboration. After all, it's our collective effort and shared insights that will pave the way forward. I encourage you to participate actively in the Q&A portion. Again, thank you for being here, and let's make the most of the Traders Playbook. Here's to productive discussions, valuable connections, and maybe even a few breakthrough moments along the way. Good afternoon.
Thank you so much, Sir Pat Dumlao, for that inspiring welcome. As you mentioned, hopefully we will be learning so much from today's session. Moving on to our first speaker for today. He served as the Dean of the John Gokongwei School of Management and the Chair of the Department of Economics at the Ateneo de Manila University. Currently, he holds the position of Associate Professor of Economics at the same university. His research and teaching interests span macroeconomics, financial economics, and international finance. His current working papers delve into topics such as the mandatory credit allocation of banks, to the agriculture agrarian reform sector, as well as others, the supervisory fee of the Bangko Sentral ng Pilipinas, to the banking sector, and modeling coordination problems. Now, before joining the Ateneo 20 years ago, he worked as an actuarial programmer for Insurance Services Office in New York City. He obtained his doctorate in economics from Fordham University, the Jesuit University of New York. Without further ado, let's all please welcome Dr. Luis F. Dumlao.
Good afternoon. Thanks for having me here. To save some bandwidth, please allow me to stop my video for now. And then let me share my presentation. And the presentation that I have, the title is The Latest in Philippine Fundamental Macro Environment in today's first MetroSec's Traders Playbook session. My presentation is something that's standard, which I took from, I borrowed from a colleague, Shell Habito. It's the PITIC test, which stands for presyo, trabajo, and kita, or inflation, employment, and GDP. Then I'll take on finance, specifically international finance. I imagine that some of you are concerned of the strength of the peso. And then we have the public and private finance, specifically public finance. And then I'll give a mention to some of a noise that we've been hearing lately, but nonetheless, it's just a noise. We go to the letter P, the inflation. Inflation has slowed to 2.8% in January, and we look at it how bad or good it is from a historical perspective. What are the causes? Where do we stand on a regional basis? And then looking forward. Inflation has tended to be usually externally driven. For example, this is the case of the first oil crisis, then the second oil crisis in the 1970s, early 1980s, And then I have the Philippine debt crisis in blue because it's self-inflicting. It's not something that is externally driven. Then you have the global recession and the Kuwait invasion of Iraq. Then the Asian financial crisis and the worst El Nino in recent history. Then the Iraq war, and it didn't help that we introduced the value-added tax. Then we have the global financial crisis. Then the shortage of rice, and then the latest one is the Ukraine and the peaking of the price of rice lately. For every administration, the average inflation has decreased except for President Duterte and Marcos. We have 16.2% during Marcos Sr., 11.9% during President Corazon Aquino, 7.8% average inflation during President Ramos, 4.4% during President Arroyo, and then it troughed at 2.7% during President Benigno Aquino, raising slightly to 3.9% during President Duterte, and so far 4.4% in President Marcos Jr. What we have here, I exhibit here that the inflation had peaked in January last year, 2023. And because it went up so high, it became very difficult for it to go up even as fast. And therefore, it is, in a sense, the reason why inflation has gone down has to do with the base effect. What used to be the source of inflation, which is oil, is no longer. You'd see here 11.2% increase in the transport. In January of this year, it's even negative inflation. And what became, so again, you see here the 10.7% peaking in the food and non-alcoholic beverages, only to go down in January 3.5% because of the base effect. As far as the sources are concerned, the biggest source, of course, is rice. And then what I have here, the next 2, 4, 6, and 7 are items which have the lowest inflation. So the rice, for example, has an inflation of 23%, vegetable and electricity, -21% and -5%. So the target is 3%. If we add the rice, inflation becomes 4.7%, but with this next 7%, next 7, the effect of it is -1.9, and that's 2.8%. And that pretty much explains why we have an inflation of 2.8%. There are over 60 items in the consumer price index. We have 7 here, so the rest pretty much evens out with each other. As far as the source, on January, it's emphasized the downward base effect in all 17 regions in the country, all of them going down from close to 9%, going down to close to 2% across all 17 regions. What used to be the source? Of course, it was oil, and you would see here the effect of oil. For example, this is the case where inflation was 2.2% in the midst of the pandemic, and now we'd see here February, the price of oil actually going down from $82 per barrel to $79 per barrel. As going forward, the average inflation for 2023 was 6%. In January, it was 2.8%, and because of the base effect, the inflation in February we project it to be at 2.7%. However, the base effect will dwindle down, so that inflation would it's too early to say, but as of now, too early to say as it may be, the inflation for 2024 would be 3.1%, which is within the government target range of 2 to 4%. So the main source of price is still over 20%. The base effect is putting forward downward pressure on inflation, but the base effect will dwindle as you see here, inflation slowly increasing. Still, the average would be the annual average. Too early to say. It would be around 3.1%. The jobless rate went down to 3.1% in December. What is the 3.1% unemployment in reference to the population? What do official rates mean in headcounts? We approximate that we have a population of 115,534,000. 37,322 are younger than 15 years old, so they cannot be part of the labor market. This leaves us with 78,212,000. Of those, the participants are 52,127,000. That is what the 66.6% labor force participation rate in government data. The non-participants are 26,085,000. These are the full-time students who are not working, those who are retired, and those who are just not participating in the labor market. Of that, 3.1% is unemployed, which approximates to 1,602,000. That's where the 3.1% data is coming from. The employed is 96.9%, and that gives us 50,524,000. The underemployed is 11.9%, which is 6,010,000. That means of all people who are employed, some of them could be working just part-time and therefore underemployed, or some of them would be working 12 hours except not making enough money and therefore still underemployed. So that's where the 11.9% data is coming from, which leaves us with, for lack of better term, fully employed 44,514,000. Of course, we also have OFW. Last data is 1,830,000. Pre-pandemic was 2,160,000. In terms of rates, we see unemployment going down by 1.2% from 4.3% to 3.1%. Underemployment decreasing by 0.7% from 12.6 to 11.9%. In headcounts, 907,000 new entrants and 616,000 previously unemployed, or a total of 1,523,000 became employed. Then we have 186,000 previously underemployed becoming fully employed, a reduction in the underemployment by 3%. In sectoral, based on major sectors, there are job gains in all major sectors, in the major industry groups, whether it be agriculture, industry, services. Of the subsectors, the biggest employers account for 52% of all employment, and these are agriculture, trade, and construction. There are job gains of 1,492,000 in agriculture and construction, and it more than offsets the loss in job in trade by 660,000. The top winners produced 1,980,000. These are construction, agriculture, and accommodation and food services. The top losers lose 1,096,000. These are the trade, admin and support services, and fishing and aquaculture. This is in a sense the good news. The biggest losers in terms of class is unpaid family workers. So there is a loss in low quality jobs. And then the biggest winner, 1,304,000, those who work for private establishments. In terms of the GDP, the Philippines misses the official target with 5.6% GDP growth in 2023. GDP grew by, we look at it now in the last 20 years, and business as usual benchmark or base case scenario. We see here historically, in this century at least, that there had been mild spikes during presidential elections. Of course, this is the case of the global financial crisis. This is the election of President Benigno Aquino Jr. And then the closing up of government, and then the presidential election of President Duterte. Of course, this is the peak of the COVID-19, and then the presidential election. So far, we would have a what is referred to as a negative output gap. That means the actual GDP growth is slower than its potential growth. This is the business cycle of income. That means this is what we project the economy is going to be if it's business as usual, if there's no shock. And as you see here, for 2023, we expected, the red one is our projections, we expected it to be 5.6% as of last November. And the data went out last week, it's actually 5.6%. So we hit it on the dot, and everything else pretty much offset each other. On a quarterly growth for the following year, you'd see here, it's 5.7, 6.1, 6.3, 6.3, and it will revert back to the steady state, which means steady state meaning the equilibrium growth, the natural growth of the economy. However, the annual growth for 2024, 6.1%, would be 0.2% short of the steady state. So we would still have a minor negative output gap. The sources of growth are going to be in accommodation and then transport. And in terms of long-term planning, the one that that would have the biggest potential are in accommodation and transport. In fact, these industries will double in their size in 6 and 7 years respectively. This is now the case of the expenditure side. Again, we projected it last November to be 5.6%. It actually became 5.6%. The world economies are opening up, and the net primary income practically offset the next export. These are basically the dollars that go out because of trade deficit. This is the dollar that comes in because of remittance, and they practically offset each other. For 2024, the same message. It's reverting back to the steady state of 6.3%. The net primary income, so income from as a proportion of GDP, income from remittances, will more than offset the dollars that go out because of the trade deficit, which means that we would be able to accumulate. We expect to accumulate more dollars this year. So good for finance. I go to international finance. There's not much news in terms of nothing much to worry, which is good news. The peso is expected to be stable. We are 95% confident that it will fall between 54.48 and 57.52. By the way, this presentation, I suppose, is going to be shared by First Metrosec with our participants. This is the case of the gross international reserve with respect to the import cover. For example, in October, it went down, the global financial crisis, import cover being 5.9, which means that the amount of reserves that we have is equivalent to 5.9 months of import. The October, the lowest since the global financial crisis, 6.6%. And then it peaked in December 2020 when the economy shut down. The gross international reserve peaked at $110 billion, and import cover was equivalent to 12.6 months. As of now, the December 2023, we have a reserve of $104 billion with an import cover of 7.8 months. By the way, as a threshold, as a standard, 6 is the 6 and above is relatively safe import cover, and anything below is something to be worried about. In terms of the OFW remittance, it's still increasing by the dollar, but the remittance in terms of growth has been declining. So the economy will basically rely less on it going to the future. I go now to the public finance, and what we have here is the budget surplus, budget deficit. And so for the most part, we have had budget deficits except for 3-4 years during the President Ramos until becoming negative. Just as a standard, a healthy a healthy budget deficit is 3%, negative 3%. And of course, we have had the pandemic and now it's down to, and it peaked to 8.6%, negative 8.6%. Now it's negative 4.6%. If the Philippine steady state is around about 6.2, 6.3%, then in a sense, it's a signal that we can outgrow this deficit. This is public finance and total debt. And as we've seen here is that as the debt had grown to 8.2 trillion pesos through the years, the actual debt as a percentage of GDP has gone down from 87% to 42%. So that the lesson had been, our strategy had been not to eliminate the debt per se, but to outgrow it. Of course, this trend reversed during the pandemic, going up to 14.6 trillion pesos with the debt to GDP ratio of 60%. Just a standard, to be on the watch list of the IMF, you have to, if you reach the 60% debt to GDP ratio at normal times, you become part of the IMF watch list. Of course, in terms of international finance, it's not yet normal per se because most of the countries, because of the pandemic, have debt to GDP ratios above 60%. But you'd see here, of course, that the debt to GDP ratio has declined. So if we follow that process, it would take, so in 2023, the debt to GDP ratio declines, and it could be a start of a 10-year process. As you see here, for example, this was 2008, 2009, the debt to GDP ratio of about 60% went down to 42% for 10 years. So this could be the start of a 10-year process. This is the public finance in terms of foreign debt. I'll very quick on it in the interest of time, but the lesson being here is our finance, the debt on finance is relatively our reliance on debt financing through foreign debt is very minor. In public finance, it's the same story as domestic debt had grown from 2 trillion to 5.4 trillion. The debt to GDP ratio had actually declined from 38% to 28%. But after COVID, of course, that reversed. But then again, if we go back, it has reversed so that the long 10-year process of decreasing the debt to GDP ratio will begin. This is private finance. I will just show you the performance of the Philippines in relation to our neighbors. I suppose my colleagues from First Metrosec has more to say about that than I do. And this is now the interest cover ratio, or EBIT divided by interest expense. So the point here is if you are on the red, that means your earnings is less than the interest earning, which means that means your asset would be declining. So you'd see here among our neighbors, the private sector, the Philippines has the smallest red. So in that sense, in terms of debt, private corporate debt, we are in a good position in relation to to these countries. So compared to the rest of the world, corporate Philippines is in good debt standing. I just close out with some noise, but it's still a noise. We can downplay it. It's not in a sense. Let's not put up into it, but it's still a noise. What I have here is this is the blue. The blue is the contribution of the GDP or income of these major islands, and the orange is what the government gives as a budget. So, for example, the fact that Luzon has the blue is higher than the orange. That means Luzon is a net giver, and for Visayas and Mindanao, they are net receivers. Their contribution to the GDP and then government revenue is less than what they receive from the national government. This is also what we have here. So for as long as blue is higher than the orange, then that region is a net giver. And the net givers are NCR, Calabarzon, Central Luzon, Western Visayas, Central Visayas, which is Cebu, Davao region, and Northern Mindanao, which is basically Cagayan de Oro, and the rest of the regions basically are net receivers, and many of them are in Mindanao. So speaking of federalism and secession, which is a noise, in my column today, which is published in Business Mirror, what I said here is, in republicanism, children live in the house for free but play by the rules of the house. But in federalism, children can live in their own place, have independence, but they also have to pay for their rents and other bills. And so therefore, it would be a public finance disaster if we tinker with that idea of some regions seceding. So inflation, the base effect will pressure inflation to be within government target of between 2 to 4%. Unemployment outlook is positive. Income GDP growth will barely miss the natural growth, thus minimum negative output gap. International finance, the peso will move sideways. Public finance, the long 10 years to recovery may have started. And the noise, it's just a noise, but it's let's not glorify them or dignify them, but nonetheless, the noisiest people should be careful what they ask for. That's the end of my presentation. I'll stop share and I'll start my video once again. With that, I want to thank you for this opportunity to be able to present with you. Thank you.
Now moving on to our second speaker. We are very, very happy to have him with us today. Of course, a very good friend of mine. He brings a wealth of experience to the table as a consultant and former research analyst over at First Metro Securities. Additionally, he serves as an investment strategist at Rhyme and Reason Investment Research and Management and holds credentials as a chartered market technician and a certified public accountant. Furthermore, he is a candidate for the Chartered Financial Analyst designation, and with over a decade of trading experience in both the US and Philippine stock markets, his diverse expertise in financial markets includes his tenure as an economist at the Bangko Sentral ng Pilipinas. Please join me in welcoming Mr. Aaron Sai.
Thank you, Danny. Thank you.
Go
Again. Okay, good afternoon po. Good afternoon, everyone. Good afternoon to our friends, no, and to our clients. Maraming salamat po for taking the time to join us in this year's Traders Playbook. Thank you for your understanding na din, no? Thank you, Dr. Domlao, for the insights and for acquainting us with the opportunities and risks, no, that are present in the economy. For my part, I'm here to share with you basically an update, no, about what we see in the charts of the PSEI, and unahan ko na I'm actually excited, no, this afternoon kasi as you know, matagal-tagal na rin akong bearish, no? So maiba naman, no? Bullish naman tayo ngayon, no? So if you remember the first Traders Playbook in 2019, we were able to identify the risk of the market going lower, no, based on the Elliott wave principle as applied in our stock chart, no? At that time, the market was still around 8,000, and our chart showed that it can go to at least 6,000 to as deep as around 4,700. No? And we did see the PSEI closing at 4,623 on that very emotional trading day, no, on March 19, 2020. So since then, the PSEI has been trading in a range, no? And in 2021, 2022, and up to last year's Traders Playbook, we have been discussing about the fourth wave, no, wave 4, being still in progress, no? And while we introduced the prospects of preparing for wave 5, we also cautioned, no, against going heavy as downside probability remains, no? But today, I think we are as close as knocking on the door of that fifth wave up, and at last, no, bullish din, okay, no? So ilang taon din yung pagbantay natin sa wave 4, and it did take its time forming, no? And hopefully finishing up, no? So after this is done, wave 5 na, okay? Bullish wave 5. So yun lang, wave 5 na ito. So possibly, no, this is our last hurrah, no? Then corrective mode ulit. Okay? So let's start, no? Again, for this afternoon, I'd like to share with you first what we see in the chart of the PSEI in the lens of the Elliott wave principle. Then we'll show our ever-reliable core set of macro indicators, which gives us a hint that it can support that wave 5 up. Of course, we'd like to share with you some ways to position and participate on the prospects of the fifth wave move in the PSEI. And of course, last but not the least, we wrap up with summary and of what we see and of our strategy moving forward. So let's begin with what we see in the chart. Okay, so again, as you remember, in 2019, we anticipated that the market will make a lower low to form a three-wave corrective wave. And it did drop. And looking at its form, a three-wave move, A, B, C, wave B ending lower than 9,078, and wave C ending beyond the low of wave A, no? Classic zigzag, no? Sa Elliott wave. And we thought that was it, no? And we are already on our way to wave 5 up. But when it bounced from the 2020 low, when we saw how the market rallied from the 4,039 low in 2020, well, it did not look impulsive, no? It looks like a three-wave move, no? So from there, we thought that it could just be an X wave or what we call a connector wave, making the whole thing not a zigzag, no, but a double three instead. Okay, so the drop from 9,078 to 4,039 was a zigzag. That's the first leg. In the context of double three, it's the wave W, no? The rally to 7,552 was an X wave. And there would still be the last leg down, no? Then that was the time we realized, hindi pa tapos to, no? Wave 4 seems to be extending to a sideways double three correction. And that basically was the premise of what we shared in Traders Playbook for the past 3 years, no? The last year's presentation even titled Unfinished Business, no? So hindi pa siya tapos, meron pa siyang ibababa, no? So the next question is, down to what level, no? And the answer to that question can actually be guided by the form of the wave Y, no, as we call it. So ano kayang form nitong wave Y na to, no? Kasi it can be another zigzag, but guideline of alternation tells us it can be something else, no? It most probably be something else. So it can either be a flat or a triangle, no? So later I'll show you that at least as of today, no, as of today, it seems that it is a triangle. So we placed our possibilities first, baka mag-double bottom, no? So we peg support at the 2020 low around 4,039. Then, using the Fibonacci relationships, baka wave Y, no? Baka wave Y, this last wave we are estimating is 61.8% of wave W, no? Which is the drop from 9,078 high to 4,039 low in 2020s. And from that, we put support at around 4,437. So ito po yung mga guides natin in the past year, no? Then what happened after that, no? Ayan. Okay. So ayan na, no? So from the rally high at 7,552, okay? The market moved sideways, no? First, it dropped from around 5,700 and then it made a lower high to around 7,137. And then from the 5,700 low, it made a higher low naman, no? Around 6,000. So lower high and higher low. It looks like the consolidation is bounded, no, by converging lines, no? And that form makes it a possible triangle. So wave Y is possibly or more probable na, no, na triangle, no? And triangles usually take a form of 5 waves. So A, wave B, wave C, wave D, and wave E, no? Then after that last wave, the triangle correction is done. And the next move is up. Okay, so what's the target, no? For that, we measured the base of the triangle, and then we projected it from the expected end of the triangle consolidation, which is the termination of wave E. And then we get the target of the triangle thrust, no, we call it. And the target is for the PSEI to go at least to 8,100. No? So if you remember, no, this 8,100 level is a structure high. No, it was the high in April 2015. And it was also the high in July 2016, no? Before the market surged to its all-time high at 9,078 in 2018. So it seems that this could be a simple case of history repeating itself, no? That is the market finding resistance at past price tops. Okay? Now, if we look closely to the triangle, no? Again, it is usually made up of 5 waves, A, B, C, D, and E, no? When the market dropped from 7552 to 57, the market recovered, and it recovered, or we tawag namin retraced, no? Retraced 78.6% of the drop from 7552. Then the PSEI dropped again from 7137 to around 6,000. If we measure that drop, that is the market retracing around 78.6 of the rally from 57 to 7137. So it seems that the PSEI is abiding by the Fibonacci 78.6% retracement level as it progressed through the consolidation. So with that, the question is, now that the market is rallying, no? Presumably making the wave D of the possible triangle, where could this wave D end? Okay? So usually, since there is possible resistance along the downsloping upper boundary of the triangle, we thought it is possible that the market would stop there, no? Around 6,700, and then reverse back down. But as we can see now, the market is above it already, no? Trading around 6,800. So the next possible stop is using again, no, that Fibonacci 78.6% retracement that the PSEI has been following throughout the consolidation so far. And we saw that resistance is possible around the area of 6,877, which is around the area it closed today. Okay? If wave D indeed stop around 6,877, ang tanong, kapag bumalik siya ulit to finish wave E, the last wave of the double 3 wave 4 correction, where could wave E end? No, we want to know that, no, because that level would be the springboard and origin of our bullish wave 5 projection. So ganun din, applying the Fibonacci retracement tool again, we saw that the 78.6% Fib retracement suggests that the end of wave E could possibly be around 6,136, no? Kaya lang we saw a throwover kasi, no? Again, throwover is basically the market overshooting the resistance of the triangle pattern, no? And if we interpret that throwover to be an indication of an unusually more bullish mood for the market, then retracement might not be as deep, no? So we are looking actually at the possibility of the market retracing just 61.8%, hindi 78.6%. And that puts support the end of wave E, the end of wave 4, and the possible beginning of the bullish wave 5 to be around 6,300. Okay? So again, to get the target, we measure the base of the triangle. To be conservative, we project it from the 6,136 possible termination of wave E. And from there, we got the 8,100 target for the PSEI. So again, remember, no, zooming out on the chart of the PSEI, no, so we can see our context. That triangle is the last of the wave 4 corrective structure. And that means its end is the beginning of the bullish fifth wave. Okay? So again, what's our target? First is just the target of the triangle, no? Not yet the target for wave 5, no? So projected it from 6,136. Target from the post-triangle thrust is 8,100. Then, to estimate the target for the end of the bullish fifth wave? First, we use the guideline of equality, in Elliott wave principle, which basically tells us that one possibility is for the size of the wave 5, yung itatakbo ng wave 5, to be equal to the size of wave 1. Okay? So for that, the target if wave 5, okay, the target if wave 5 is equal to the move of wave 1, based on the equality guideline of the Elliott wave principle, our target is for the PSEI to go to 9,500. Okay? Another guide from the Elliott wave, coming from the usual Fibonacci relationship among the waves, is that the run of the fifth wave can be equal to 38.2% of the run from the beginning, to the very beginning, to the high of wave 3. And for that, the target, which coincidentally, in technical analysis, sometimes we call it confluence, which often, though not always, strengthen the case for that price region. So coincidentally, the target is similar with the equality guideline. The target is also around 9,500. And next, if the market turns really bullish, another guide is for the wave 5 to run by about 61.8% of the rise from the beginning of wave 1 to the high of wave 3, which puts the very bullish target for the PSEI around 11,688. Again, that is if the fifth wave moves by as much as 61.8% of the move of the market from the very bottom up to the 9,078 high. Okay? But lastly, which I think for planning and strategy purposes, this could be our base case. So 8-1 is your conservative, 9-5 is your optimistic. Let's not look and get very excited just yet on the 11,688 until we can see how the wave 5 forms itself. The next guide is if the PSEI forms a double top, or in Elliott wave, we call it a possible truncated fifth wave, then the target for the PSEI is the retest of the 2018 high, which was around 9,078. Okay, so there it is, the picture of the chart of the PSEI, again in the lens of the Elliott wave principle. So I think that last of wave 4 is in, or we are very close to it. I think that it is a double tree combination, corrective pattern, and the last of it is probably a triangle, which could end around 6.3 to 6.130. Okay, so watch out for those levels if the PSEI retreats to those levels again. Okay, and the end of wave 4 is the base of the last wave up, which is the fifth wave. Okay, a bullish wave that we want to position ourselves for. Okay, so targets wise, base case is double top or truncated fifth. That is 9,078, same as the all-time high made in 2018. Then conservatively, 8,100. Based on the post-triangle thrust measurement guideline of the Elliott wave principle, not really a target for the end of wave 5, but just from the triangle consolidation. Okay? And the bull case is for the PSEI to go to 9,500. Extra bull is 11,688, though again, it is a possibility, based on the guideline of the Elliott wave principle, using the Fibonacci relationship. And we will definitely be happy, monitoring whether the probability of it happening would increase as the wave 5 forms itself. Okay, so there, you may take a screenshot if you like, Okay, so before we move on, okay, in the Traders Playbook in the past 2 years, I think, we presented this picture of the PSEI along with this red line, which is its 50-month simple moving average. So as discussed before, the 50-month SMA seems to be a good guide as it has served as both support and resistance for the PSEI in the 90s, when the market was in similar mood. And recently, when the market was topping and then dropped and then move fairly sideways, no? So if we look at it closely, the 50-month SMA has been providing resistance for the PSEI since it dropped in 2020. Okay? But since 2022, there's been several attempts to go above it. No? So the first successful close above that MA was in January 2022. No? Only for February 2022 candle to cast some doubt on that January's bullish move. No? And then eventually it went lower and went back below the 50-month MA. No? In January last year, ganun din, no? That market also attempted to break above the 50-month MA. But ito, medyo mas masama. It failed to close the month above the MA. And once again, the bullishness in January was reversed by February. No? The market dropped, but as mentioned, the PSEI dropped to a higher low, no? Around 6,000. This year, January closed above the 50-month MA. And so far, February is above the 50-month MA, which is currently around 6,500. Okay, so ang tanong is, will February price action do the same reversal that the Februaries in the past 2 years did? No? Or will it stay above the 50-month MA and perhaps the 50-month MA will reverse roll, no? Roll reversal, and now act as support instead of resistance. Okay, so that we have yet to see. No? So we'll keep tabs on this. No? So that's a picture of the PSEI based on the Elliott wave, based on the classical technical analysis through the moving average. It seems that there is a case to expect higher PSEI level moving forward. Again, this is wave 5. Okay? This is the last hurrah, no? The last up move in the 5-wave impulsive structure, we call it, no? After the 5th wave, we will again be in a corrective phase, correcting the whole thing from the beginning of the PSEI data to the end of wave 5, no? So with that, we think this is the time to participate in the market until signs that 5th wave is coming to an end are presenting themselves already. Okay? So next po, no? Let me share with you how the macro factors that we have been keeping tabs on, as we believe they have good correlation with the movement of the equities market in general. No? So these indicators are looking to be supportive of the prospect for the wave 5 in the PSEI. So syempre, first dyan, no, is the global benchmark, no, the US 10-year yield. No? Again, the view on the US 10-year yield is still that of a bullish reversal, no? Bullish for the yield, no? That is a possible continuation of the surge that we have witnessed since it hit bottom in 2020, no? It broke above the resistance of the long-term downtrend line, which was in effect, which has been in effect since the 80s, no? And it made higher high when it broke above 3.25% in 2022. And more importantly, at least in the Elliott wave principles perspective, if we look at the form of the run-up from the 2020 low, the US 10-year yield made 5 waves, no? So, which means that the trend that the market is building now is that of an uptrend. So, but what's supportive of the 5th wave in the PSEI is that as of now, no, the US 10-year yield is in a corrective phase, possibly still building the wave B up, and would still have to go lower to finish up wave C. No? And that is good for the equities market. The development in the US 10-year yield is also reflected in largely, in our local benchmark, no, the PH 10-year yield, no. The PH 10-year is in a similar path, also in a corrective phase before resuming its upward move, no, when the correction is over. Okay? Then the peso-dollar exchange rate. So we have shown you time and again in previous playbooks that the historical relationship of the PSEI and the peso-dollar exchange rate, no, more often than not, no, definitely not always, when the peso depreciates, the PSEI goes down. Okay? And when the peso appreciates, that is when the peso-dollar exchange rate goes down. Okay? The PSEI goes higher. Okay? So, and as we can see from the chart, it seems that the USD PHP is still in a corrective phase and is yet to finish its last leg down, which suggests peso appreciation is in the horizon, which again is good for the equities market. Okay? Last but not the least, yan. So far, ayan, and that's a big so far, no? Because this was also one of the bull case support for the at the beginning of 2023, no? Only for it to reverse and end 2023 at a net foreign selling position. No? So far, year to date, as of last week, no, latest report, the PSE recorded net foreign buying, no, for the stock market. No? I actually had a conversation with our prop trader, no, about this net foreign buy. I was asking if he noted foreign transactions, so that could have quote unquote artificially influence, no, this net foreign buying position year to date. Sabi niya, so far mukhang may interest daw talaga, no, from foreign investors, and definitely that's a good sign. Okay, so now that we are almost at the edge of wave 4. Okay. How can we position naman ourselves, no, and our portfolio to ride and benefit from the coming fifth wave? Okay? So, syempre, ang pinakasimple dyan, no, is to buy the PSEI. Okay? So, syempre, to buy the PSEI, we buy the PSEI trackers, no, like the First Metro ETF, no, or the Exchange Traded Fund, no. So, kailan bibili, no? When to buy it, no? You can buy it now actually at this level, no? If the PSEI goes to at least 8.1, that's around 17% upside from where we are now. And if the PSEI goes to the base case double top and go to 9,000, that is 30% upside, no, from current level. So first option to ride the fifth wave in the PSEI is to buy the PSEI through the PSEI trackers, no, like the FM ETF. Okay. Next, if some of you want to be more specific, then one option is to prefer the heavyweights in the index. No? So if the PSEI moves higher, most probably it would be driven by interest and buying into these heavyweights in the index itself. No? So you have your SMs, the banks, no? ICT, Ayala Land, and AC, among others. Okay. But if we are talking about which PSEI stocks would move at least as much as the move in the PSEI, or better if it moves more than the move of the PSEI in the same direction, then you might want to consider buying into these high beta stocks. No? A beta of 1 means that the stock moves as the move of the as much as the move of the PSEI in the same direction. If beta is more than 1, it means when the PSEI goes up by, say, 1%, okay, the stock goes up by more than 1%. Okay, so these are your options, no? The high beta stocks within the PSEI. Next, if you are the type who considers valuation as a priority, but still want to participate in the anticipated up move, then you might want to consider participating by buying into these PSEI stocks that have the highest potential upside, at least based on the latest available consensus target of different analysts in the market. So for instance, from this list, if the investors' required return to risk their money in the market is at least 30%, then visually you will have around 8 to 9 stocks now from the list which satisfy the minimum required return. Okay? And lastly, which most probably you have heard, no, about these stocks already amongst your friends, no, who are also in the market, no, kasi sila talagang gumagalaw recently. So if you think momentum on this PSEI stocks would continue in the course of the fifth wave, no, them being the leaders in the move, no, then these are your options, the leaders so far among the PSEI constituents. Okay, so there are your options. First, buy the PSEI through the PSEI trackers like the FMETF, or you can choose among the PSEI heavyweights, or you can consider buying into high beta PSEI stocks, no? And then the value plays within the PSEI, and of course the leaders that some of the PSEI constituents now have been outperforming others now recently. Okay, again, all this are within the context, no, of the anticipated bullish fifth wave for the PSEI. Okay, so now at this point, no, let me share with you some stocks that I think may have moved enough to give us bullish signals. Okay, so first is this one. Okay, Monde, no? As we know, this stock has dropped from 20.7 high down to 6.1 pesos, no? High quality company, good management, great products, no, which are among the market leaders, maybe not the market leader, but among the market leaders in their respective categories. But the stock price has been falling. Okay, but that was before, no? When it made its low last year with the bullish reversal pattern, it made a higher low, and now it picked above the resistance of the downtrend channel from its all-time high. So I think there's a good bullish reversal case for Monde, no? Just be mindful that the strong showing of Monde, no, it actually closed today higher by another 2%, no? The strong momentum up has brought the stock near the first targets, no, around the gap in March around 10.80 to around 11 pesos per share, no? So at this point, wait for the correction to reference moving averages and perhaps the area around 10 pesos per share. Okay, so that's Monde. Next is Converge, no? Similar with Monde, Converge IPO was hot, no? It even brought the stock price to as high as 45.40, and then it fell hard. Okay, down to 7.63 in 2023, no? But when it was around that level, no, and from its recent price action, it seems Converge is forming a double bottom bullish reversal pattern, which if it breaks above the resistance above 1040, it could lead to the reversal of this previous downtrend. So as of today, the stock is still finding it difficult not to go above 1040. No? So just watch out for the possible break above that resistance of the possible double bottom. So maybe you can use the stop limit break order, no, to position your the prospect of buying into the breakout in case it breaks above the 1040 resistance. Okay. Then GTCap. No? So this stock has been on a downtrend since 2016. No? A series of lower highs and lower lows. No? But what's interesting is the break above the area around 670 per share. Okay, so if that holds, then a bullish reversal might be on the way. Today, it dropped by 3.47%. No? So let's see if GTCap can stay above 670 and its 200-day moving average. Okay, so for the PSEI, 3 stocks, Monde, Converge, and GTCap. Okay, for the next part, I'd like to share 3 non-PSEI stocks that I think are showing good promise on what we based on what we see on the chart. No? So syempre, first is DNL. No? Fundamentally, I like DNL. No? Crisis level valuation around 570, not too far from the recent low. And the company, in my view, has been protecting its moat with its new facility, which can allow it to capture more in the supply chain. Yun lang, they have to take on more debt. No? And when we look at the chart, it seems that we are possibly in the beginning of the wave 3 of 3, we call it, no? Which for wave traders, this is one of the most profitable waves we can ride on. Okay, no? So it actually moved strong today, closing almost 4% higher. No? But more importantly, I guess, no, it managed to break above its 200-day moving average. Okay, DNL. Next is GMA7. So election is around the corner. Well, not too close yet, no, but closer than before, no. So competition is reduced, as we know. They have so far played their cards well. They're still there. Okay. Year-to-date 2023 profits might not be as pretty as 2022 profits, but dividends, even on the same proportion as the drop in 2023 profits versus 2022, remains to be attractive. No? So again, the investment merit is to position for the anticipated improvement in profits in the coming year. So looking at the chart, I think the downward correction is over. It seems that the market has been accumulating and it breaks above 910. So when it breaks above 910, I think there's a good chance for double-digit percentage gain for this stock. Okay? And lastly, all HC. No? So looking at this chart, I'm anticipating history possibly repeating itself. No? We can see here back in 2020, when all HC consolidated after a drop, it formed a triangle, then broke above the resistance of that triangle, and we can see the price action that followed. No? Now, all HC is moving very similar to its 2020 price action, so I thought Playbook can also be similar. As we can see from the right edge of the price action, it has just broken above the resistance of the triangle consolidation since September last year. In today's trading, all HC rose to as high as 210, challenging its 200-day moving average. No? Kaya lang bumaba. No? It retreated a bit to close at 2.06, still at 3.52% higher for today. So watch out for that break above that 200-day MA, no? As it can give traders more reason, no, to be long on this stock. No? Similar to the signal that it gave the market back in September 2020. Okay, so there you have it po. No? Thank you for listening. No? Napahaba ata. Okay, in summary, again, we are of the view that the PSEI is nearing the end. No? Wala pa doon. No? Pero nearing the end of this corrective wave 4. May wave E pa. So it took some time, more than 6 years actually, no, from 2018 high, no, but at least we are getting there, no. So next is wave 5. Wave 5 is bullish. Wave 5 is the last wave. So just keep that in mind in case the bullishness, the excitement of the bulls gets in the way of right psychology. Okay, so what are our targets? From the triangle wave Y, 8,100. Then from if wave 1 is equal to wave 5, target is 9.5. No? Same with the 38.2% relationship between the wave 5 and the waves 1 to 3. Okay? Target is 9,500. If in a very bullish scenario, wave 5 extends and moves 61.8% of the move from wave 1 to wave 3, target is 11,688. But again, don't look at it just yet. Okay? Let the waves unravel itself first before we look at that level. Okay? And lastly, our base case. Double top, no? A retest of the 2018 high PSEI at around 9,000 level. Okay? So again, just a reminder. Okay? Wave 5 is the last hurrah. No? What follows is a meaningful correction downwards. So stick with the plan. Keep a guided psychology. When the market runs upwards, I hope it does, no? Don't get too excited. Okay? We have our targets to guide us. Participate within a guided path. Okay? And for the strategy, risk on, no? This is wave 5 for the main index, no? The PSEI. So priority is the index, no? And its constituents, no? But it is also possible that the sentiment towards the main gauge, the PSEI, can lift the tide, no, for non-index shares as well. So if what we see here plays out, then risk on, no? Participate. Okay. How to position for the wave 5? First, the index trackers, then the heavyweights based on market cap. Okay. The high beta stocks in the PSEI, no, not in the all shares, no, PSEI lang. Okay. Then also an option are those that are still cheap based on consensus target price as seen on Pro. No? Then the leaders in the PSEI, and then for the individual stocks, among the PSEI are Monde, Converge, and GTCap, no, based on what we see in their charts. And lastly, some non-PSEI stocks, DNL, GMA7, and all HC. Again, these are the ways to participate, no, in the fifth wave of the PSEI and what it has to offer. But as always, syempre, no, make sure that your chosen strategy fits your personality, risk tolerance, and of course, behavior towards what the market presents to you. No? So, ingat kapag na-excite. Okay? So, buy at comfortable levels based on your system and trail your stop, no, in case the market goes against the anticipated direction. Okay, so with that, thank you very much po for your attention, and I hope you learned something useful today. Thank you.
All right, there you have it, ladies and gentlemen. What I really enjoyed are the comments that you see, Aaron. Kailangan mong isa-isahin kasi ang dami pa nilang tanong on the other stocks. What about this stock? What about this stock? But very, very interesting takeaways I have there. Risk on, but still, of course, be very, very cautious. It's up to you if you believe in the 11,000 are very optimistic, but very, very interesting to have these specific indicators that were provided. No? So thank you so much for that very concise technical analysis. And on that note, again, if you have any questions, I know that there's a lot already I've been seeing in the chat box, but please make it very clear na question that you want me to throw to the panel, because this will be very different from your comments here, all right? So use the chat box and say this is a question for the panel, and try to make your questions as concise and clear as possible. All right, ladies and gentlemen, thank you so much for your patience today and, of course, your participation. And let's keep that momentum going. It's my pleasure to introduce our third and last speaker for today. She is the head of the Institutional Research Department over at First Metro Sec, where she oversees the analysis of Philippine-listed stocks in key sectors such as consumers, financials, property, REITs, and telco. She also contributes to generating in-house market views and outlook for the team. She holds graduate degrees in finance from the University of the Philippines and industrial economics from the University of Asia and the Pacific. She earned her Bachelor of Science degree in economics from the same university. Let's all please join me in welcoming Ms. Estela del B. Villamiel.
Again, hi everyone. I'm Estella from First Metro Securities Research. And for the rest of my presentation, I will share with you our outlook and strategy as well as topics for the year 2024. We remain guarded on the Philippine equities market for the time being. To borrow a phrase from Lewis Carroll's 1865 classic, Alice's Adventures in Wonderland, we find the Philippine equities market falling deeper down the rabbit hole this year. This is given that we see a lot of factors that we think is affecting the current investment backdrop and should affect our charted outcomes as they develop or unfold. Among our key uncertainties would be, of course, the asynchronous shifts in monetary policy stance, and of course, the moves of central banks in the last 24 months do have impact and effect on global and domestic growth and earnings profile. The factors listed here on your screens, they could be positive, they could be negative, but our view here really is that we have to wait for them to unfold before we can have more certainty as to their, investment implications. So until we see that, our view is to wait and see for now. And at First Metro Securities Research, we always start our analysis on where we are in the business cycle. As you can see in this chart right here, for those who remember, we did show this early in 2023, and at the start of last year, we have already been conservative on the market. Our index target last year was 6,700, and the index did end flattish. Na late ng 1 month, yung 6,700, 6,850 target namin, which was revised mid-year. But our view is that over the course of the last 12 months, the Philippine economy navigated late cycle dynamics. Essentially, we had peaking inflation, tight labor market, and also, of course, elevated interest rates. The tricky part on where we are right now is that the market will oscillate between positive and negative narratives as we move through that transition between the late cycle and into the slowdown phase. While we are guarded, we are also not forecasting a recession for the Philippines in any way, just a slowdown nevertheless. So our view here is that until we see more durable signs of recovery, we would prefer to stay cautious, trail your stops until we see more durable signs that another economic cycle has begun. And that is our timing in terms of when we want to enter the market in a big way. So for our base case index target, it's at 6,700. And we have a target range of 6,000 for our bear case and a bull case of 7,400. Right now, where the market is trading, it's north of 6,800, and the market is factoring in that bull case scenario. However, in our view, a lot of things have to fall in place before that 7,400 is reached, among which would be that your economic momentum continue to grow above trend, or I guess we again see north of 6% growth for the Philippines. And also, of course, deeper than expected cuts in interest rates will provide tailwinds to your valuations. Until then, and if and when those do not materialize, we see the market to end closer to our base case target of 6,700. I guess to explain more clearly on our assumptions, for the bear case, this assumes that growth risks continue to manifest for the Philippines, meaning we grow sub 5% perhaps in terms of the economy. And in terms of your corporate performance, of course, demand destruction stemming from the payback of previous demand and also the extended period of above target inflation would lead to below trend EPS growth as well. Meanwhile, for the base case, this assumes a soft landing for the Philippines, essentially a moderate slowdown. And in terms of our corporate earnings performance, we see mid-single digits growth. That is about 5% for 2024 and 7% for 2025. For our bull case, as I've mentioned earlier, GDP has to grow above trend, and that should allay concerns on the Philippines' economic resilience. Of course, that should also translate to, I guess, above trend growth for corporate earnings as well. Finally, for the valuation side, we like to look at the market in the context of equity risk premium, meaning that ERP versus the US 10-year bond yield. So in terms of ERP, of course, given growth risks to the economy and earnings, we do forecast a 470 bip ERP amid the heightened risk of backdrop. Meanwhile, for the base case, this assumes that the US economy sticks the landing. Our base case forecast is the Fed will cut rates by 100 bips in second half, but this is essentially to just shift policy toward the neutral stance and not necessarily shift toward more easing. As for the bull case, this assumes that the Fed shifts to a more aggressive easing cycle to boost recovery in view, of course, of a slowing US economy and inflation, and better than expected growth for the Philippines, as well as lower than expected risk-free rate should, of course, provide tailwinds to valuations, thus, again, resulting to our bull case target of 7,400. In terms of our valuation range, we are looking at the 10.5 times to 12.5 times PE for the market. And this assumes that the this is whether the US 10-year bond yield will end between 4% to 4.75%. And also your ERP would be between 400 to 475 bips. And assuming that our EPS forecasting is correct, then that will translate to a base case range of 6,100 to a 7,200 range for the index in 2024. Our key calls for the Philippine Equities Market. First of all, we see Philippine consumption will continue to grow below potential. Second, we see mid-single digit earnings growth for corporates. Third, valuations are expected to stay low for longer. And fourth, foreign fund flows will remain muted for the remainder of the year. We remind everyone that monetary policy operates with a lag, and we think that the full impact has yet to be fully reflected in the economy and earnings. For those who listened to the BSP's press conference yesterday, one of the answers to the Q&A was that they do expect a 5 to 6 quarter lag in terms of monetary policy impact. And they did say that given the magnitude of the recent moves from the last 24 months, they expect that lag to be a bit longer. And that is very much in line with our view that over the next course of perhaps 2 to 3 more quarters, we should see that impact to be fully reflected and thus result to a slowdown in terms of economic performance. We have a research partnership with DBS of Singapore for over 10 years now. And our economists from DBS are expecting 5.3 and 5.4% economic growth for the Philippines in 2024 and in 2025 in line with our view. And why we think that there is a case for a slower or rather below potential growth for the Philippine economy, we essentially attach it to our outlook on Philippine consumption. Let us remember that household consumption in the Philippines approximately accounts for 70% of GDP. And we see some reasons on why we think that households heading into 2024 are not so much in a good shape in terms of their spending outlook and behavior. First of all, in terms of the BSP's latest consumer confidence index, or expectations rather, we see that forward-looking consumer expectation as of the fourth quarter is actually lower than the last COVID lockdown trough we had in 2021. And also, in terms of your retail sales, you can see here that it has modeled through flattish and even negative performance over the course of 2023. On one hand, this could be due to base effects. 2022 was a stellar in terms of recovery. But also, we think that consumers have begun to reassess their spending priorities and tighten belts in recent months. Also, as for inflation, it's I guess it would be easy to cheer the consensus view that inflation will revert back within target band or within 2 to 4% target in 2024. But I guess our concern here is that cumulatively, if we actually look at where prices are now versus pre-COVID levels, they have risen significantly, and based on our computation, it's about 20% versus end 2019 levels. So our view here is that apart from the negative wealth effects of inflation, we are more concerned actually in terms of consumers' propensity to spend, because it would be one thing to be able to afford items, but it's another to be actually willing to spend more. As for remittances, it is normalizing in terms of US dollar terms as the global economies recovered, of course, from COVID. And our view here that there is unfavorable translational impact if and when there is a case for a peso strength, which actually our DBS economists are forecasting over the course of 2024 and 2025. I believe they are looking at about 54 pesos to the US dollar and 53 pesos by in 2024 and in 2025. As for consumer balance sheets, we can see here that it has risen by nearly 70% since we more substantially reopened sometime in the middle of 2021. Actually, our call, for those who recall, when we had that lockdown in 2020, our view was that consumers had no spending options, no movies, no restaurants, no services. And hence, a lot of us were able to actually pay down debt and repair our balance sheets. And as we reopened, again, as I've mentioned, we did tap our credit lines. Our view here is that on one hand, this could be due to bridge the gap between being able to afford items because of the high inflation, but also on another, we acknowledge that, of course, we just reopened. It feels good to spend again. So a lot of us did tap that credit line to be able to satisfy our pent-up demand. However, our view is that going into 2024, interest rates have risen and we're already done spending. So it's time for consumer deleveraging, in short. And the view is that we see consumers to prioritize repairing balance sheets first before they again engage in more substantial levels of consumption. And there would be arguments that, not everyone has credit lines, credit cards, for one. But our view here is that if we actually look at the house or Philippine consumption data based on Euromonitor, we see that the deciles 5 to 10 actually account for 80% of Philippine consumption, which means that if they don't have the propensity to spend, then that will negatively affect, of course, the employment and incomes as well of your lower income deciles. And essentially, that is where our concerns on Philippine consumption is rooted. And until we see a more substantial recovery in spending for at least the mid to high income households, then we prefer to wait for now until we see better signs of recovery. Second, we see mid-single-digit earnings growth for corporates this year. That is at 5% in 2024 and 7% in 2025. One thing that we want to highlight here is that even in good years, we see that corporate earnings rarely grow by double digits. we actually grow by double digits only if coming from a slowdown to 1 or 2 years after slowdown. So our view here is that at 5-7%, take the average, it's just about equal to that 6.5% growth we have seen over the last decade pre-COVID. And our EPS forecasting actually is based on a top-down multi-factor regression model, which takes into account macroeconomic variables. And just to, I guess, provide some insights, our data actually is trimmed until fourth quarter 2019 because we want our model to be able to capture that drop in 2020. And we did miss some few quarters right there, but so far it has reverted within trend. And we continue to use this model for our forecasting for index level EPS. And our story for corporate earnings essentially it flows through from last year's, wherein we said that we should see negative leverage play out. And when we talk about negative leverage, I'm talking about a slowing top line, and yet your fixed cost as well as your financial cost continue to rise. In fact, as early as 2021 and in 2022 as well, we already highlighted this playbook that we have seen in during the global financial crisis, wherein what happens during crisis is that corporates cut costs, whether it's to cut some labor, cut some office space, or refinance debt at lower interest rates during crisis. That results to margin expansion 2 years later, essentially given that your top line recovers but your cost base is low. However, what happens fourth or third year down the third or fourth year after the crisis is that margins actually recover, and that's something that we did expect in 2023. So far, it has panned out. In 2020, during the recovery in 2021 and in 2022, we also saw that recovery in margins, but margins have normalized come the third year, and into 2024, we expect the same. Among reasons would be that, of course, with slowing inflation comes weakening business pricing power. They cannot anymore pass costs as ahead of inflation as it will significantly affect demand, of course. And among reasons why we think fixed costs will continue to rise in 2024 is that, for one, there are proposals for higher minimum wages, as you know. In fact, case in point, in 2023, 13 out of 17 regions raised minimum wage, and the full impact will still be felt in 2024. Notwithstanding, of course, other factors such as your return of contracted rent escalations and the continued rise in utilities expenses. From a financial side, the direction of interest rates, of course, has implications on earnings growth. We show here a nice scatter plot of your 91-day treasury bill rates lagged by 8 quarters and your corporate net income margins. And what we see here is that there is actually a strong negative correlation at the 6 to 8 quarter lag on interest rates and corporate net income margins. And what we are essentially saying here is that if you look at your gross debt levels in September 2023 versus end 2022, for your largest corporates, it appears to be flattish. But as you know, the corporates you are watching or following have already refinanced debt at higher levels. So the full year impact of that will unfortunately be still felt in 2024. And as for corporates as well, they are hardly looking to expand. If we look at it from the perspective of the BSP's business expectation survey, we do see that it hardly recovered in terms of the percentage of businesses with expansion plans over the next 12 months. And also, if we look at the top corporates' actual capex spending in 9 months 2023 versus 9 months 2022, we do see that it's rather flattish, just about 6-7% year on year, as opposed to the previous years in terms of your historical compounded annual growth rates. And the concern here is that, of course, delayed capex spending may have negative implications on future EPS growth. As for valuations, we do expect them to stay low for longer. It's easy to host this event and tell everyone that our PEs are actually down or at levels -2 standard deviation relative to historical mean. Also based on this valuation composite, which we have developed for First Metro Securities, it is composed of your forward PE, PB, EV to EBITDA, dividend yield, or rather the inverse of dividend yield, and the historical premium or discount of Philippine equities to emerging market benchmark index. It also shows that the Philippines, based on relative valuation metrics, is trading at attractive levels. However, as I mentioned early in my slides, we prefer to look at the market from an equity risk premium perspective. It is our preferred valuation method when we look at the index, or rather at the market at an index level. And essentially what the key takeaway from this chart on your right is that ERP is a measure of expected risk to earnings and growth. If and when the market sees some concerns in terms of the economy or earnings, your ERP shoots up. As we have seen during the 9/11, that long-drawn period of war and U.S. recessions, global financial crisis, Eurozone crisis, and also during the COVID-19 pandemic. What we want to highlight is that at current levels of the market ERP against the US 10-year bond yield is actually at 400 bips. And the historical 10-year and 20-year average is 380 bips. So if we look at it from that perspective, it is not as cheap as the market appears in terms of relative valuation. And essentially that is why we would prefer to accumulate at better valuations from an ERP perspective for the index. In fact, if we look at it from a PE perspective, we would prefer to compare that current 11, 12 times PE to another high interest rate environment. And if we look at the peach line right here, right now the market is about 11.7 times PE. If you look at the pre-GFC interest rate levels, the market is actually just about the same levels. So is it as attractive relative to another high interest rate environment? I would think that the market actually is about fair value at these levels right now. And again, I guess to summarize our view on valuations, the restrictive monetary policy do have lagged effect and the impact remains to be seen. So that should result to higher equity risk premium. And the higher for longer narrative in the US, of course, should dampen prospects for valuation expansion. Especially if, of course, the Fed navigates the US economy into a soft landing, then there is no case for the Fed to cut rates drastically and for the US yield curve to fall as much as consensus is expecting in terms of how much it can boost valuations from a risk-free rate perspective. And our fourth key call for the market is that foreign fund flows will remain muted. We acknowledge that foreign funds are underweight the Philippines. This is based on the historical allocation of your GEM funds. We actually account for less than a percentage of these larger GEM funds. And also, if we look at it from the perspective of the foreign ownership levels of Philippine stocks. And our view is that there is not much compelling reason for foreign funds to enter the Philippine markets given alternative investment opportunities. Of course, right now you have your competitive bond yields, and also in developed markets, the US market is of course attractive for a lot of investors given prospects of the US economy. Also AI as a theme is attractive for foreign investors as well. And I guess for China, as a smaller emerging market economy, us, the Philippines, would rely much on whether China could deliver on its growth prospect. As shown in the previous slide, we only account for sub 1% of that global emerging market index. So for a big economy like China accounting for 30% of that index, we would prefer to see a more robust recovery for China before we should see foreign investors to more significantly drive flows into EM markets again. And that is important for us given, of course, that the Philippines historically is driven by passive institutional flows. As you can see here, a lot of the outflows we have seen in recent months actually came from the outflow of passive institutional investors. And just for reference, the data I'm showing right now is based on a subscription-based data, that's EPFR, wherein we prefer to track this data given its, I guess, good visual correlation in terms of the cumulative 52-week cumulative flows relative to the year-on-year performance of the Philippine benchmark index. So where we could be wrong, Fed policy error in either direction. Don't get us wrong, we are also in that soft landing camp. Our view just right now is that the economy is transitioning from a late cycle to a slowdown phase, and even for the US economy as well. And soft landings, while they are ideal, they are rare, and history is not on our side at the moment. If you look at the history of the Fed relative to the US economic performance, I think soft landings only happened twice or thrice across US history. And of course, there are risks of, say, over tightening, thus resulting to a hard landing for the US, or whether a premature easing would actually result to no landing for the US, meaning inflation continues to be hot and the economy continues to gel. Thus, there is no reason, or rather, there are more reasons to keep rates elevated for longer. Second is a clear the deck event. In the last 24 months, we have had some close calls such as the US regional banking crisis, the failure of Credit Suisse, cryptocurrency exchange troubles, and the ongoing Chinese property sector crisis. And so far, they have not resulted to a more substantial financial impact and spillover on other markets. But let's remember again that tighter financial conditions in general puts pressure on weaker links in the economic value chain. And our concern here is that, fingers crossed, we do not see another black swan event that happens over the course of our forecast horizon. Third is the exodus of foreign funds. We saw, again, based on EPFR data, that when the US 10-year bond yield tested the 5% level sometime in the second half of last year, the acceleration of your active institutional outflows actually materialized. So our view is that we could see another acceleration of foreign fund outflows if the 10-year US bond yield claws back up and stays above the 5% level. And I guess a nice chart that I would like everyone to have as a key takeaway from this presentation is that Philippine Equities Market, we expect it to chart a volatile path over the next 12 months. There will be market rallies driven by policy rate cuts, as it is happening right now. For reference, this strategy we actually crafted it sometime in December, and we did expect market rallies to happen. But again, we think that a durable rally emerges only when rates bottom and a cyclical recovery takes hold. Again, trail your stops and let's wait for the lookout for signs of a cyclical recovery. And as I've mentioned, we recommend staying guarded on policy rate cuts for now. Because, of course, if policy rate cuts are deeper than we expect, as you can see, as they have happened in the last easing cycles, then that results actually to negative performance for the PSEI. So how do we position? We advocate patience and active, nimble management, as they will be key to outperformance. We prefer to focus on defensive picks, those with visible earnings growth despite a cyclical slowdown, and those that offer value and, of course, have yield. And our key themes for the market are as follows. First of all, we would like to maintain a defensive stance. We like Century Pacific. Century Pacific, we did make a call sometime mid-2023, and we said that tuna prices are peaking at $2,000 per metric ton sometime in April or May. As it happened, actually, as of January, tuna prices are now at about $1,400 per metric ton. So that call has panned out, and I do acknowledge that our target price has been breached already at current share prices of Century Pacific. Nevertheless, our view is that this should, of course, result to sustainably elevated margins for the counter over the next 12 to 24 months, and we would very much prefer to accumulate Century Pacific in case of corrections. Also, in terms of valuations, we are targeting a +2 standard deviation valuation for CNPF, given that, as we all know, it's now part of the index. So that is a welcome development that should allow for more better investability and visibility for investors for Century Pacific. For Robinson's Land, our view here is that we are actually underweight on the property sector, given that it is a cyclical sector that is sensitive to an economic slowdown. Nevertheless, why we like Robinson's Land is actually given the mix of its revenue and earnings drivers. As you can see in these two charts right here, relatively more balanced the RLC in terms of the resi contribution, the office contribution, and the malls as well. And that's something that we welcome, especially that we think that the residential segment, especially those property names with exposure to mid to low income segments of the resi segment, should be in a not so good shape as we navigate the high interest rate environment right now. Meanwhile, for offices, RLC continues to have a competitive portfolio, mostly PEZA accredited and mostly concentrated on BPOs, which of course continue to deliver on a rather more stable performance as opposed to an exposure to traditional offices. Meanwhile, for the malls, malls continue to contribute a significant portion of RLC as well. So, nevertheless, we would prefer to, I guess, keep watch for now of other property names that have more mall exposure, because even as your malls grow by, say, mid-single digits this year, it will not be enough to pull up the overall earnings of your property name if they do have a large exposure on residential and offices as well. So in short, we like RLC given its defensive mix, and hence that it is part of our defensive picks for 2024. Our second theme is embracing the income theme. We do like REITs, but we are selective. We like MREIT and RL Commercial REIT. For MREIT, it continues to offer the best exposure to the resilient BPO market that is very much rooted in the strength of its sponsor, MegaWorld, which of course is your biggest office landlord in the Philippines. But more importantly, we like MREIT given that management is actually already done executing that share price placement. And we think that asset injection should be within reach over the next 12 months. That would be paramount to driving growth and dividends. There may be questions on whether, of course, I mentioned that we are underweight on the office segment, but we have already imputed a conservative view in terms of the rent per SQM growth for offices. I think we just assumed 2% year-on-year per SQM. And also, we did not assume any other asset injection. So if you can see here, our DPU growth for MREIT actually is about flattish only. And essentially, that's why we like it. Even assuming very conservative forecast without asset injection, we think that MREIT can deliver stable dividends, and hence we would prefer to lock in yields for this stock. We did double down on this call sometime in 2023, and our view really is that in the case of prospects for rate cuts, of course it would be the best time for you to lock in yields. As it happened, the spread between the MREIT and the Philippine 10-year bond yield actually has already narrowed, and that call continues to pan out. And as you know, MREIT will be taken out of the MSCI Small Cap Index. So if and when there are downside pressures to the counter, we would very much prefer to accumulate the counter on dips. Meanwhile, for RL Commercial REIT, expect reliable returns from this stock versus other REITs in our coverage. Actually, RCR is able to grow rent per SQM nearly 5% so far in 9 months 2023. And fundamentally, as I've mentioned earlier, we like RLC for its office. We also like RCR given its exposure to BPOs. It has PEZA accredited and high quality buildings. And essentially, if you look at RLC and RCR's exposure, mostly they are in the Ortigas area. So historically, pre-COVID, Ortigas area is relatively competitive in terms of rate, in terms of rental rates. So in the environment where your office lessees have more leverage over your office lessors, then they would very much be attracted to offices with more attractive rates. Um, the overhang for RCR at the moment is a potential share placement, given that its free float is actually just hovering at that regulatory limit of a one-third public float. But we think that we would very much prefer, again, to accumulate RCR in case there are corrections on the stock resulting from this. And of course, let's not forget that asset injection sets the stage for more assets inside the portfolio, thus bringing an upside to dividends. Similar to MREIT, we did for our clients who are in touch with our been reading our reports, we did double down on our call for the REITs, and so far we have seen that meaningful correction in terms of spread between the RCR and the Philippine 10-year bond yield, and we continue to see that especially as rate cuts happen. So it's the best time to lock in yields right now for RCR and MREIT. For PLDT, we continue to like it given its strong fundamentals. For fixed line, it continues to be your number one player. It will be further strengthened by the Sky acquisition, which we view to be to add about 300,000 subscribers to the stock, to its fixed line subscribers, thus further solidifying its number one position. Meanwhile, for mobile, if you see the results of that SIM card registration act, it's not too far from Globe in terms of total mobile subscribers. So that goes to show that PLDT actually is not too far as a second player, and we like PLDT for that. But more importantly, why we like PLDT is the fact that it has a stronger balance sheet relative to its peers with mobile segment. If you recall, it has done some tower sales over the last 12 months, 24 months, and it did result to special dividends. And that goes to show that PLDT actually has better balance sheet. They can already spend for whatever capex they will need without the need for additional boost on tower sales. That of course should be supportive of potential higher dividend payout, especially that our view for capex as a percentage of gross service revenues, it will continue to decline below 30%, especially that PLDT is already done expanding in terms of its 5G network and also in terms of its fixed line. So we think that that a higher payout should be within reach. If not, at least the very least we expect payout to be sustainable for PLDT. Just a caveat, we have not assumed that higher payout. It is an upside to our estimates. In terms of valuations also, PLDT is trading at attractive valuations currently at just about 5.4, 5.3 times EV to EBITDA. And we think that these are good levels, especially for a big telco player that is PLDT. And finally, for our third theme, we is bucking the negative leverage narrative. I mentioned earlier that when we talk about negative leverage narrative, we are talking about a slowing top line, and yet your fixed cost and your financing costs are increasing or have pressures on margins. But we see some names that we think can still deliver growth despite a cyclical slowdown, among which include your Converge. We do like Converge fundamentally. We like that it has embarked on a prepaid fixed line broadband segment. I think that the market has not appreciated this yet, but in our view, it is actually the right way to go for Converge because it will allow Converge to actually get a share of wallet for the prepaid mobile segment. Essentially, when we talk about prepaid fiber plans, the question is whether does it increase your addressable market? And when we talk about addressable market, say your decile 1, can they afford a fixed line broadband? If you make it prepaid, they can do so already, given that, say, they can only pay 50 pesos for 1 day. Technically, I can already afford a fiber plan. And the next level there of question is that whether it will increase the spending on telco services for household. Of course, the rational answer is no, especially for those lower income segments. I have say I'm a decile 4. My budget every month is 705 pesos. already including my mobile and my fixed line budget. So just because I can afford fixed line, do I necessarily spend on it? Our view is that for these sensitive households, they will actually reallocate their spending, wherein on days when I will be, say, working from home, I can reload my prepaid fiber line. And then on days when I am outside, I can reload my prepaid mobile. And essentially, that is why we think this will work for Converge, is because we do not see any cannibalization impact in terms of whether that said customer shifts between a fixed line or a mobile. And as opposed to its other competitors, if they do begin, or I think some of them have already offered prepaid fiber plan, we think that it will cannibalize some spending in terms of mobile. So for Converge, we think this is the right way to go, and we see Converge to actually deliver 7%, at least 7% growth in 2024 and 2025. That's already faster than your incumbents, who historically deliver, I think, just about mid to low single digit growth annually. As for Jollibee, it is on track to exceed management guidance, whether it's in revenues, SSSGs, operating income, even store network expansion. And we like Jollibee for that. The Jollibee we are seeing now is stronger post-COVID. I recall we made that sell call on Jollibee during its peak in 2019, saying that, there's a lot of things that need to be fixed with Jollibee, but so as COVID happened and as they did that business transformation program, we are shifting our view and taking on a more bullish stance for Jollibee. Especially that if we look at its margins, you can see that the international margins have actually recovered substantially versus COVID, and I guess versus against the years when Smashburger and CBTL are still loss making. And in terms of group owned versus franchise stores, Jollibee is actually operating with more franchised stores now, which essentially means it's good for Jollibee's margins going forward. So we think this is sustainable, and we think that Jollibee, despite cyclical economic slowdown, should be able to deliver growth over the next 12 months. Finally, for URC, straightforward, we think that there is positive leverage in place for this stock. Since 2018, they have done a lot of cost restructuring in terms of their manufacturing operations. They are now operating with a leaner OPEX structure, and of course, with a smaller cost base, even as that increases, it will not impact you as meaningfully versus another company with a higher fixed cost base. Also, we see that it should be able to continue to deliver double digits operating income growth, improving ROE, and strong balance sheet. And we like that they have already actually offloaded their Oceania business, which, as you know, carried high cost debt along with it. So on hindsight, it's actually a good timing, especially where the market or where interest rates are right now. Just a final note on URC, I guess, we think that the regulatory risk is being overestimated. We think that the House will not pursue taxes on the salty and junk food taxes and sugar sweetened beverages, especially in an environment where your households, as mentioned earlier, is not in a good shape heading into 2024. Of course, still reeling from the impact of high inflation. And also the single-use plastic tax. If you do read that bill, it's actually just talking about your secondary packaging, meaning URC as a food manufacturer, they use the primary packaging because the plastic they use come in contact with the food. But when we talk about secondary packaging, if you go to your grocery and they put it in a plastic bag, that's the secondary packaging, and that's where the single-use plastics are actually meant to be imposed upon. And of course, URC will not be affected by that. Yeah, I as a last slide, I guess I will show this quick peer table on where our picks are. Again, our themes are maintaining a defensive stance. We like CNPF, RLC. Also embracing the income theme, essentially your yield plays. That's MREIT, RCR, and PLDT. And bucking the negative leverage narrative, we do like Converge, Jollibee, and Universal Robina Corporation. And as a final note, First Metro Sec is a member of the Metro Bank Group. By policy, we do not cover listed companies within the group, i.e. Metro Bank, GT Capital, and Philippine Savings Bank. I will end my presentation here. Thank you very much.
Thank you so much, Ms. Del, for that very remarkable and comprehensive presentation. A lot of questions from our audience here, as you can see from the chat. And at this point, we will be calling back to the screen our fantastic lineup of experts for our panel discussion. And if you still have last-minute questions, try to submit them and we'll try to get to them. So once again, can I please call on Prof. Dumlao, Mrs. Telia, and of course, Mr. Aaron Sai for a quick discussion. Okay, I'm gonna kick off with Prof. Dumlao here, who of course talked about the risks to the economy. In the last presentation with Ms. Villamiel, she mentioned that consumption in the country has been below potential. What is your view on consumption, especially as you've mentioned that inflation will hopefully, remain muted this year, despite the fact of the base effect dwindling? Are you actually seeing supply side inflation effects being addressed when it comes to the rice prices? And is this going to then translate into better consumption?
Consumption is going to be, it's projected to be still below its the steady state, below its natural growth. In fact, for the year, we expect it to grow by 5.6% as opposed to 6%. In terms of inflation, the main source is still going to be rice. What it was last year, it was vegetable and sugar and fish and meat. But even those right now, they've tamed down. It's just that the rice remains the stubborn factor, and unfortunately, it has the biggest weight in the consumer price index, and that's why, in a sense, there is a level. There are opposing things. There's inflation forcing. There's inflation and rice forcing inflation to be high, but still there is a level effect on vegetable, meat, fish, and the like. But still, for the rest of the year, it's 3.1%. That's pretty decent. That's on target, basically.
Prof, just a follow-up on that, no? Can we say that revenge spending post-pandemic, all the savings that were accumulated during the pandemic, is over? The revenge spending is gone. We are looking at a tighter situation in the economy now, but because we did see a couple of quarters where the expectation of consumption was, outshone. We thought even the GDP growth was higher than expected, at least earlier last year. Can we expect some bright spots like that Filipinos are continuing to spend despite how much inflation is hurting our pockets?
The consumption revenge basically peaked in the first quarter of 2023, and then from that on started to decline. But again, the steady state is 6%. The consumption is going to grow below its natural path, its natural growth rate. But nonetheless, 5.6%, it's still one of the highest around the world. So I don't know if it's kind of half empty, half full thing. It's definitely below the natural growth, but still, it is still one of the highest around the world, precisely because, one reason is other countries have lower natural growth than ours. Yeah.
Okay, I'll move on first to Aaron. You showed us a lot of the technicals in the charts, no? Anything from up to 11,000 on the main index here, which is a proxy, or theoretically, it's a proxy of our economy. It should have, the biggest basket of all our biggest industries. Can you give us an idea why there is a disconnect between what, Prof. Dumlao has mentioned? It might be a difficult consumption year, and yet you still have these bullishness in the charts. Why is it so disconnected?
Well, for one, it's not very uncommon. No, it's not very uncommon for the financial market, especially the equities market. No, the more forward-looking type of a market, no, to be somehow um, having some differences, no, with what we actually on the ground, no, be it in economics or be it in fundamentals, no. Again, sometimes, no, sometimes the suggestion from the price action could lead, no, what we can see from the ground, no, from what we see in the fundamentals improving maybe, or some in the economics. Now again, as far as what we presented in the macro backdrop, no, I'm sure Dr. Dumlao and Estela also presented some of the factors that the financial markets are looking at, no. But again, there's yung mga core natin, no, yung mga core natin, the yield and the exchange rate, and of course the foreign flows, no, at least as indicated by what the PSE is publishing, no, kasi yun lang may access tayo, no, is encouraging for now, no, encouraging for now, especially the anticipated direction. And again, those anticipated direction for those macro indicators, macro financial indicators, no, are supportive of a possibly bullish.
All right. I saw another comment in one of the chats of our audience here, basically asking about short selling. Can you relate that, the possibility of short selling that's, of course, recently introduced by the bourse, and how that would impact on your projections?
Oo nga, nakita ko nga eh. So siguro ano, no, siguro actually again, the wave 5 is the last hurrah, no? We are on our way there, no? Malapit na tayong matapos sa wave 4, and there is a window, I think, no, still for wave 5, no? The short selling has already been there, no? Wala pa lang yung actual facility for the market to trade, no, to short the market, no. So wala pa. Hindi ko alam kung kailan sila magiging able, no, na to short the market, but I think it can actually make it worse siguro, no, when we go to that target. If we would go to that target, to those higher target levels, no, when we go to those higher target levels, tapos na introduce and naging effective na yung shorting, tapos maging broad based pa, no, kasi yung ngayon yung guideline sa short selling is limited to certain stocks lang, no. But if the shorting becomes more applied in a broader basket, then maybe it can actually mark the top of the market. So isa yun sa pwede natin tignan when we actually go higher from here.
All right. Well, we'll wait for updates on that, of course, from the SEC and the bourse. Moving on to Miss Del, no? I wanted to ask specifically, of course, you mentioned the BSP decision on Valentine's Day, basically, to hold rates. And you mentioned that we are hoping, of course, that the rates go lower. Should we be waiting for the rate cuts, which they've already mentioned is not likely to come anytime soon, at least not in the first half of this year? Should we be waiting for rate cuts in the second half of the year before we accumulate?
Yeah, in terms of our view, as I showed the slide earlier, our view is that rate cuts are welcome and they will of course be supportive of market performance. However, the concern is that after your initial cuts happen, you don't know if there are follow-through cuts if and when the slowdown in the economy is more, I guess, more substantial than I guess the central bank or even consensus is expecting. And I guess that is where we are more guarded about. And just for reference, we do see the BSP to cut rates by 100 bips in the second half of this year. So more than that, it should signal that the economy, or rather the central bank, is seeing that the economy needs more support. And hence, we prefer to accumulate on corrections, if any, and trail your stops. We are not telling our clients to sell the market, nevertheless, even as the market is rallying. But we prefer to stay cautious and continue to implement a defensive playbook. And we would prefer to go in a big way on cyclicals if and when those rate cuts are done, because that will signal that the cyclical recovery is already happening.
Okay, so wait for the rate cuts for the cyclicals, but in the meantime, stay defensive, right?
Yes.
All right, now back to Dr. Dumlao. We become insulated now from the external shocks, the issues of, of course, COVID-19 has finally, hopefully, gone away. The oil situation, the war in the Ukraine, etc. Have we managed at least to become more self-sufficient in terms of these external shocks? There's still, as you mentioned, our dependency on the Fed and how the interest rates are moving because of that differential. But apart from that, have we at least, are we more self-sufficient? Are we more insulated from global events?
It's not that we're more self-sufficient. It's just that whatever adverse effect that war and the geopolitical things, noises that could hit us has already hit us.
Okay.
And therefore, we're not feeling it anymore because we had been hit already. So it's not like we're stronger or not. It's just that we have been hit already. And whatever that adverse effect, we already felt it. And it's in a sense, it's there.
Okay. Could you say that our economy is more resilient, Prof?
Uh, well, the thing here is we've been affected also by, even before COVID-19, our trade has declined. And that is function of the trade war between China and the US. And then there's increasing fragmentation. Even Europe is starting to decouple itself from China. And the thing here is China, Japan, the US, there are three biggest trade partners. And I think that's precisely why one of the reasons, even the trade, the trade that we have, in terms of dollar value, it's the highest in history. But the trade in terms of its as a proportion of GDP, it's still far, around 7%, far from where it was in 2017 before the trade war began. So it was the trade. The trade was equivalent to 72% of GDP. Right now, it's just 67, 66%. So we are still feeling the effect of those trade wars, and whether these wars continue or China makes an adjustment to be fair to the to the to the likings of the West, then we all stand to benefit from that.
Okay. Aaron, still related to the foreign side, let's talk about the foreign fund flows into the equities market, which has been basically bearish outlook, no? And I think it was mentioned by Ms. Del, there are just more attractive things out there. Are they not looking at your same charts that present, this fifth wave that they might be interested in? Or are they looking at the earnings potential? Is that too low, the single digit earnings growth that they're looking at? What's it going to take to get these foreign funds back in?
Actually, hindi ko rin alam. Yes, no, actually I agree, no. If you look at the options for foreign investors, and if you compare it with what we can offer, madaling madaling magpass sa Philippines equities lalo na, no. So siguro you can go to Philippines, maybe try your hand on the fixed income, no, because of the better yield, no. But if you want to risk your money in equities, no, you have other options, no, especially other markets haven't recovered just as strong as the other like the developed markets. So yes, there are possibly lack of reason siguro, no, for an anticipation of strong foreign inflows, no. But again, nevertheless, no, yun lang yung medyo medyo ano ba, characteristics ng technical analysis, no. We look at the price movement. We don't know yet, no, just like our previous projection, no, or anticipation. We didn't know at that time what was the market discounting, but we know how they are moving know, how the market price is moving. And again, those clues, though we don't know why they're doing what they're doing, no, led us to somehow anticipate the next possible move for the market. And now, for now at least, that's what the chart is telling us, no. So siguro possibly enough na yung we have been kept at the side on the sidelines for much longer than we should, no. Or siguro we can somehow factor in the fact na again the fixed income market, the yields are actually correcting, no. So we don't know yet how far it would go low to the lowest, no, especially if inflation would come down more meaningfully, no. Of course the policymakers could be incentivized, no, as we know, higher interest rate could actually cost the not just the corporates, no, but also the economy as a whole, no. So as policymakers, they wouldn't want to sakal, no, sakal the economy, no, with higher rates. So if they have that opportunity, they would, no. And again, the market rates would follow, no, for fixed income. So maybe that can be part of the reason, no, why there could be such a possibility of a bullish stance for the PSEI, no. But then again, for foreigners, no, while siguro ang nakikita ko lang sa mga pinresent ko, sa mga kino-consider ko, siguro ang isa lang sa mga factors na pwede nilang parang incentive, no, for going here. Well, pwede yung yield, no, yung yield correcting further downwards, no, and of course yung peso appreciation. So again, peso appreciation is good for foreign investors. So they'll have aside from what they can earn potentially from the equities market, they can also earn from the appreciation of the local currency when they repatriate back their money home.
Alright, so baka marketing lang pala yung kailangan sa ating foreign investors. And finally, just time for one last question. I guess still on the issue of rates, and I think a lot was mentioned on the bond yields. Of course, when the bond yields are higher than what we're getting from equities, the equity markets stay quite bearish. Back to Ms. Del, no? Can you give us, since of course a lot are watching, a lot are retail investors as well, can you give us a sample allocation, maybe for the year, of how much percentage equity, how much percentage fixed income, and maybe even REITs in between that we should be looking at here for a balanced portfolio?
Yeah, we're a stockbroker, so my recommendation would be to, I guess, lock in yields through REITs. But of course, for clients who do have access to the bond market, you have your RTBs. I think they're also available through our platforms. They can also lock in yields, especially that the outlook for interest rates is to go down. That's something that we do acknowledge. Again, I always circle back to that cyclical slowdown that we are expecting. If you are unsure of whether your favorite stock is unable to deliver that growth in terms of EPS, then at least for the yield, let's go with the sustainable ones. I guess the better REITs, as I've mentioned, we like MREIT, RCR, and bonds also would be something that we would be recommending as well. Perhaps if and when the recovery happens in 2024 and into 2025, we would be among the first ones going rara and saying, let's go in this market. We are starting that cycle already. And finally, this volatile environment is over, and hopefully towards 9,000 after Sir Aaron is saying earlier. Yeah.
All right. Well, we all hope for that, of course, ladies and gentlemen. Unfortunately, that's all the time we have for the panel discussion. Hopefully, you learned a lot from these amazing three people here that have shared their time and energy and insights. Thank you once again to the three of you for your participation today. All right, ladies and gentlemen, I'm so happy to have been your host here. Let's also thank, of course, of all our partners that have made this event possible. Shout out to our Fund Smart partners. You can see those on the screen here. Thank you so much to BPI Wealth First Metro Asset Management Incorporated, Atram, Sun Life Asset Management, Phil Equity, and Manulife Investment Management for making this event, Traders Playbook 2024, possible. And finally, to cap this off, I'm very delighted to introduce Mr. Gonzalo G. Ordonez, the President of First Metro Securities. Please join me in welcoming him for our closing remarks.
Ladies and gentlemen, as we draw the curtains on Traders Playbook 2024, I am filled with gratitude for the collective spirit of curiosity, engagement, and collaboration that has defined this annual event. On behalf of First Metro Securities, I extend my sincere appreciation to each one of you, our esteemed speakers, insightful panelists, our articulate and charming hosts, and our dedicated attendees who have stayed the course of this enlightening journey. The organizing team afforded us with a venue to scan the markets through different lenses, providing the economic framework and theory from the academe, on-the-ground insights from our in-house economists and equity analysts, and the interpretation of a technical analysis expert / successful buy-side market practitioner, which made for an interesting intersection of views during the panel session and the Q&A. Our speakers have been the architects of knowledge, sharing their expertise and illuminating the complex tapestry of the market. To our attendees, your unwavering commitment to staying throughout this event reflects a shared passion for knowledge and a dedication to staying at the forefront of market trends. Your participation has always been the heartbeat of Traders Playbook. And we are grateful for your presence, your questions, and the vibrant exchange of ideas during the session. As we part ways, let the knowledge we gained serve as catalysts for future success. The journey doesn't end here. It merely evolves. And the insights gained today will potentially tweak the financial decisions you make tomorrow. On behalf of First Metro Securities, I extend our deepest appreciation for your active participation and the positive energy that has permeated this event. Thank you for being a vital part of First Metro Sec Traders Playbook 2024. Until we meet again in future events and shared explorations, wishing you all continued success and prosperity.
Thank you, Mr. Ordonez. Thank you, audience. You have been patient, you've been amazing, you've been participative, and to help us improve even further in our future events, please do take a moment to complete the feedback form. You can access that link as you exit the webinar. Once again, this is Danny Laurel. Hope you enjoy those insights and have a great weekend, everyone.